everyone, it is day 17 of our 90 Days to Taxes series. In this series, I'm taking new businesses or businesses that may be a little bit disorganized. I'm helping you get organized and ready for tax season. Today is all about depreciating assets, and I want to give you a forewarning that this video is going to be long because depreciation is complex and there are a lot of options on many times when it comes to depreciation that can impact the amount of tax that you pay. So depreciation can be a great tool to help reduce your taxes in that year, but then there are potential consequences for future years. I want to make sure that you understand it so that you can make an educated decision when it comes to depreciating assets. So in the last video, I talked about what is an asset. If you're unsure what an asset versus an expense is, go ahead and watch that video and then come back to this video. So I am going to be using publication 946 today to help guide you in this video. This is a publication that if you are going to be depreciating property, I highly recommend that you read it. So oftentimes I'll pull these publications up and they just kind of provide a little bit of guidance. This publication is something that you'll come back to time and time again. It is extremely important, extremely helpful. So when it comes to depreciation, depreciation allows us to take an asset and divide its cost over the course of its useful life so that we can get a benefit for purchasing that particular asset. Okay, so it is for assets that we own, and I'll go over information on how do you know if you own it, because there's certain structures of leases that are actually ownership. Again, it's a confusing topic, but asset or depreciation allows us to take the cost of that asset and allocate it over the useful life of the asset. And I say useful life with quotations because the useful life is determined by the IRS, okay? So it's not determined based on like, oh, this truck's gonna last me 10 years. Nope, the IRS is gonna tell you how long you depreciate that asset over, okay? So first thing we've done is we have our asset. We have established that this particular item is truly an asset, okay? It is an asset and we need to figure out how to depreciate it, okay? Now, I am going to go over today general depreciation, and then I'm going to make separate videos on types of accelerated depreciation because, again, we have a lot of options, and for simplicity's sake and preventing this video from being like an hour long, I'm going to kind of cover it over the course of multiple days. Okay, so let's dive in. We are going to ignore section 179, and we are going to ignore this special depreciation or bonus depreciation because these two items are an accelerated form of depreciation, meaning we get to take all or a lot more of the value of that asset the year that it is placed in service than what general depreciation gives us, okay? So I'll go over accelerated depreciation later. Okay, so again, I'm going to skip this. So this is the introduction. It is going to explain how we can recover the cost of business or income producing property through deductions for depreciation. In other words, it is going to tell us how to allocate the cost of an asset over its useful life. Okay. Now, there are different types of assets that have some special rules. A car or a vehicle is going to be subject to some weight limitations, okay? So the IRS doesn't, or the Internal Revenue Code, Congress, I should say, has passed regulations that prevent business owners from going and buying luxury cars and then taking a huge, massive accelerated depreciation the first year that that car gets put into service, okay? So there's some regulations that are specific to the gross weight of vehicles. Residential rental properties. Rental properties, both residential and commercial, have some specific rules I'm going to go over. Office space in your home. This is for business use of your home and your office. This is a whole separate video that I did, okay? And then farm property. Farmers generally get some different tax breaks, but I'm going to cover some different types of farm equipment in here. So let's go over an introduction. This is going to kind of explain what property can be depreciated. So we are going to be looking at types of assets that actually can be depreciated. Things that cannot be depreciated. So there's some certain assets that you can't depreciate them. Like, so sorry, you just can't do it. One of those is land. Okay, land in general cannot be depreciated. So when we have a property, a real estate property, and we maybe have, a building, and then we have land, the land portion of the cost of that property cannot be depreciated. So we actually only depreciate the assets that are on that property that can be depreciated. We have to allocate a cost to land and then a cost to the building and the other assets that are there. Okay, there may be some land improvements that we can depreciate, but land in general cannot be depreciated. There are always going to be exceptions to regulations, okay? There are certain instances in which land, the value of it can be expensed. Those kinds of things are going to be, if you are operating a farm and you are doing things to the land, or if you are going in and you are depleting natural resources that are on that land, you have to go in and there's special ways that you can write those expenses off. And then take, an expense against that asset. I'm not going to go into that because those are very specific scenarios. So in general, we don't depreciate land. So when does depreciation begin and end? In general, it's going to begin when that asset gets put into service. So it's actually not when you purchase the asset. It is when that asset begins operating and is making you income. Okay, so if I purchase a piece of equipment November 15th, and that piece of equipment is not installed until February of the following year, my depreciation does not start until that actual piece of equipment is in service. So if it gets installed in February, I start using it in February. In February is when I am going to start depreciating that piece of equipment. I cannot depreciate it when I purchase it in November. Okay? When you put that piece of equipment in service, or that asset in service, is when you begin your depreciation. When does it end? The IRS tells us the useful life of these assets. It's funny though, because you'll see, like if it is a 5-year asset, generally it's going to hit your depreciation schedule over 6 years instead of 5 years, because it's going to take a portion of the first year and it's going to put it on the front end. Like it's going to take essentially a portion in year 1. Then you'll take, the next 4 years, and then you'll have the last year, which is technically year 6, you'll have a portion of a year there as well, okay? What is the basis? So I kind of went over that in the asset versus expenses video. Your basis is generally going to be the cost. You're going to have to look at adding things like excise taxes, sales tax, freight, cost of installation, okay? How do you treat repairs and improvements? So this is a good question. If you have something that is a repair, you can immediately expense that repair. However, you have to keep in mind that a repair does not improve the property. Okay? So for example, if I go in and I just completely gut a building that I've purchased, and then I go in and I completely renovate it, some of those are going to be improvements, okay? Some of those are going to be improvements. And improvements are brand new assets themselves, okay? Do you have to file Form 4562? I'm going to show you this form. This is where you depreciate things. This is how you report your depreciation to the IRS. And then how do you correct depreciation deductions? I'm not going to get into this. If you have an issue with your depreciation, the way that you correct that is you either amend the return depending on if it was like the last filed return that you did, or if it was a substantial number of years. It depends on your scenario, but let's say it was 4 years ago. You're going to file a form to correct the depreciation when you file your tax return. Okay, I'm not going to go into that because it's complicated. Okay, let's go into, and I'm going to forewarn you, this is a very, very long publication. Okay, I'm going to pause it and I'm going to find the spot that I want so that you're not sitting here watching me scroll. Okay, right here, what property cannot be depreciated? Land. We already went over this. Land cannot be depreciated. But you can see here, although you cannot depreciate land, you can depreciate certain land preparation costs, such as landscaping costs incurred in preparing land for business use. Okay? Expected property. So if property is, or accepted, excuse me, if property is placed in service and disposed of in that same year, you don't depreciate it, you just calculate a gain or a loss on that property. And then there's some other items in here that you're not going to depreciate. You can look into this. I'm not going to explain all these because these are going to be rare, okay? Okay, now what happens if you retire that asset before depreciation is over? Okay, so you sell or exchange the property, you convert the property to personal use, you abandon the property is destroyed, or you transfer the property to a supplies or scrap account. So if you get rid of that property before depreciation is done, okay, what ends up happening at that point in time, that property is no longer eligible for depreciation because it has gone out of service. What happens when you depreciate a property, an asset? You have your initial cost basis, okay? So let's say that I paid $560,000 for a specific building, okay? And I've depreciated that building $200,000 to date. That depreciation actually reduces your basis in that property. So if I purchased it for $560,000, that was my initial basis. I've depreciated it $200,000. My new adjusted basis is $360,000. Okay. If I sell that property, I'm probably not going to sell it for exactly $360,000. I may have a gain if I sell it over $360,000, or I may have a loss. If I have a gain, I may have to recapture some of the depreciation. In other words, I may have to go in and essentially back out of the depreciation. My gain will be divided into depreciation recapture and then just general gain, okay? And those are taxed differently. If you convert the property to personal use, this is very, very dependent on how you are taxed, okay? If you are taxed as like an S corporation or a C corporation or a partnership and you pull property out of that business for personal use, that can be a problem. So don't do that unless you have a tax advisor to help you. You can create kind of a little bit of a tax situation for yourself. But once you pull it out for personal use, you're not depreciating it anymore. You abandon the property is destroyed. There's all different kind of scenarios at which if you're going to retire this asset from service, and that depreciation is going to stop. Now, the next part, what method can you use to depreciate your property? You must use the modified accelerated cost recovery system. We call this MACRS, okay? This is the MACRS depreciation system to depreciate most property, okay? MACRS is a system where it is a modified accelerated cost recovery system. That's the name of it, right? So what that means is that the first year is going to get you the highest amount of depreciation. So that first year, now there's a partial year, so generally the second year, since it's a full year, is actually more. But the IRS is assuming, or Congress is assuming, that you're getting more value out of that asset when it is new. So you're taking the majority of the cost, we're front loading it. Okay, so your benefit of depreciation is going to go down as the asset gets older. That's MACRs, and I'm going to show you this here in a minute. You cannot use MACRs though for certain types of property. So property placed in service before 1987. If you've placed a property in service in your business before 1987, I'm assuming that you probably are not looking for help understanding depreciation. You've probably understood it by now, I would hope. It's been almost 40 years. If not, like, I'm not making fun of you, but you know, I'm assuming you're familiar with depreciation. Certain property owned or used in 1987 or 86. It's a little kind of an odd specific item. Intangible property. Intangibles are things that you can't touch. Okay, so trademarks, copyrights, rights to be able to utilize an option for something, or a license, something along those lines. Those are intangibles. And intangibles don't use MACRs. Intangibles are actually amortized, excuse me. Amortization is like depreciation, but it's for intangible items, okay? We just call it something different. Amortization is straight line, which means you literally take the cost basis of that asset and you cut it up into equal pieces over the course of its useful life, and every year you deduct the same amount, okay? Films, videotapes, and recordings, certain corporate or partnership property acquired in a non-taxable transfer, property you elected to exclude from MACRs. The other thing that is not depreciated with MACRs is buildings, real estate, okay? There is commercial real estate and there's residential. Commercial real estate is depreciated on a straight line basis over 39 years. Residential real estate is depreciated over a straight line basis over 27 and a half years. Okay? Now, real estate's a little bit of a different beast because you can, or you should really, be breaking those buildings and the property, like what you're purchasing, up into different components. Like land, for one, is not depreciable, but then you have your buildings, and then you may have other components that you're going to be breaking that property up into. We call it a cost segregation. Not going to get into that, but cost segregation breaks that property up into different assets, because 27 and a half years and 39 years, that's a long time, right? So you don't necessarily get a lot of depreciation benefit from real estate when it comes to like the actual building themselves, okay? There's other components though that you may get. For example, if you buy like a furnished residential rental, you may have appliances in there. Those appliances are not going to last 27 and a half years. So we can break those out and depreciate them over shorter periods of time, okay? Okay, this is going to get a little confusing, so I'm going to go a little bit slow here. So what depreciation method are we going to apply to these assets? There's 3 different depreciation methods under GDS, and then there's 1 depreciation method under ADS. This is all under MACRs, okay? Now, there is the 200% declining balance method with the GDS. This is the general depreciation method that we use when we use MACRs. There are some assets that can elect to use the 150% declining balance, okay? And then there is the straight line method. ADS is required for some farmers. There's GDS and then ADS. Now, this is a example of the depreciation methods, or not an example. This is the table that we follow. So non-farm assets that are 3-year, 5-year, 7-year, and 10-year property use the GDS 200% declining balance. It provides a greater deduction during the earlier years. And then we have the GDS using the 150. So this gives you information on what assets can be used under each of these methods. Okay? There's GDS using 200%, GDS using 150%, GDS using straight line. Notice non-residential real property and residential rental property is right here. Okay, and you're also going to notice like there's some weird stuff in here. Trees or vines bearing fruits or nuts. Like when I show you the depreciation tables and the different types of assets that are in here, you're probably thinking, well, how am I going to know where I fit? You'll find a fit, trust me. So this table is great. This is going to tell you what method you're using, okay? Now, in addition to knowing what method we're using, we also have to know which convention we're using, okay? There's a couple different types of conventions. So and I'm just gonna show you here where it is in this publication so you can reference this publication to help you. The convention you use determines the number of months for which you can claim depreciation in the year you place the property in service. So remember I said that first year you're only going to take a portion of the year for depreciation, and then the next so many years you're going to take a full amount based on the percentage that I'll show you here in a minute. And then that last year, again, you're taking a portion of the year. That is based on when you put the property into service and the type of property that you are putting into service. Okay, so you'll see here the mid-month convention is for non-residential real property, so that's real estate, residential rental property, and any railroad grading or tunnel bore. Mid-quarter convention. So you use this if the mid-month convention does not apply. And then we also have the half-year convention, and this is going to be if the mid-quarter or the mid-month applies, or does not apply, sorry. So the mid-quarter is going to be generally, where you're going to hit. And so you're either going to generally have mid-quarter or mid-year, okay? These conventions are going to tell us the percentage of the first year that we're taking, okay? So it's going to affect the first year and then the last year of depreciation. Okay, now I have scrolled all the way down to the additional material section, okay? This is where our tables are going to be. These tables are extremely helpful, extremely helpful. If you are using a tax software, as long as you answer the questions properly, it should give you the correct calculation. However, I always check them just in case. These are the tables that you can use to check those, okay? So first what you're gonna do is you are gonna use this chart to determine what depreciation table you're gonna go find, okay? So you're gonna go here and you're gonna find what macro system are we using? Are we using GDS or ADS? The majority of us are gonna be using GDS. And then we're gonna say, okay, are we doing 200%, 150, straight line? What are we doing here? A lot of assets here are gonna be in the 200, okay? Then we're gonna look to see what is the recovery period. I will show you how to look up the recovery period here in a minute. So we have 3-year assets, 5-year, 7-year, 10-year. There's also 15, 20, and then there's also 27 and a half, 39, okay? Then we're gonna look at convention. So are we using the half-year convention, the mid-quarter convention? Now, if we are using the mid-quarter convention, so I'm gonna show you what this looks like for the GDS at 200% for, let's say, recovery period of 5 years, using the mid-quarter convention, and we got this asset was placed in service in the second quarter. I am going to use table A3. Okay, I am going to scroll down and I'm going to find table A3 right here. And it's going to tell me this is for 3, 5, 7, 10, 15, and 20-year property using the mid-quarter convention placed in service in the second quarter. I am then going to find my recovery period based on the tables I'm going to show you here in a minute. And it is going to tell me, okay, if I have a 5-year asset, I'm going to take 25% of that cost in the first year. Okay? I'm going to take 30% in the second, 18% in the third, 11.37% in the fourth and fifth year, and then I'm going to take 4.26% in the sixth year, okay? So even though it's a 5-year asset, it's going to have 6 years worth of depreciation because we're getting part of that first year and part of that last year, okay? So this is the percentage that I get to depreciate. You'll notice we get a higher percentage at the beginning of the life of that asset, right? If you notice, this is placed into service in the first year, and you'll notice, in the first quarter. You'll notice I get a bigger chunk in that first year, even though it's part of a year, because it was placed into service earlier in the year, okay? Now, I'm going to pause this, and I'm going to go and I'm going to show you the tables that give you the recovery period. Okay, now I have table of class lives and recovery periods. This is how we determine the number of years that we are going to be depreciating these assets over, okay? So you'll see right here we have GDS for Mackers. We have a whole slew of assets. So I'm going to point out some ones that are probably going to be common in your business, and then I'm going to point out some ones that are a little wonky so you can see there's classes for everything. So we have office furniture, fixtures, and equipment. Information systems, so computers and the peripheral equipment. You'll notice that office furniture, fixtures, and equipment, we depreciate that over 7 years. Our information systems, we depreciate that over 5. Airplanes, if we had an airplane, we could depreciate that over 5 years, okay? So you're gonna see, like, there's a lot of different items on here. Land improvements, 15 years. Agriculture, so includes machinery and equipment. Grain bins, that's 7. It's got little asterisks because it may be subject to some different items. Oh, if we have a dairy cow, it is going to be depreciated over 5 years. I told you there's pretty much everything in here. Sheep and goats that are used for breeding are 5 years. Hogs that are used for breeding, 3 years. It even gives us classes for horses, okay? We have, let me scroll down and show you, manufacturing of textile yarns. It's got a whole slew of different things in here. A whole set of assets. Manufacturing of motor vehicles, special tools. There's railroad items on here. There is telephone communications. There is a ton of stuff in here. A lot of this is probably not going to apply to your business, okay? So there's a ton. Theme and amusement parks. We can go over 7 years, okay? So there's a whole slew of things that you can find in these tables. The majority of you obviously are going to be looking at the front of this or the beginning of these sets of tables for things like office furniture, equipment, that kind of stuff, buses, light general purpose trucks, land improvements, that kind of thing, okay? So this is our Mackers tables. These are our Mackers tables in this publication 946. You're going to need to use these if you're planning on, calculating your depreciation and doing your tax return yourself. Now, I'm going to pause again because I'm going to pull up your depreciation form, and then I promise we're at a half hour. I'll finish this video after that. Okay, this is our form 4562. And the first part 1 that you're going to notice is the election to expense certain properties under section 179. This is an accelerated form of depreciation I'm going to cover in its own video because it's important that you understand how section 179 works. It's a great tool, and I want to make sure that you have enough time and all of that to watch it. Part 2 is special depreciation allowance and other depreciation. Special depreciation is another way of saying bonus depreciation. So you probably know special depreciation as bonus depreciation, okay? This is bonus depreciation. And then you'll notice part 3 is MACR's depreciation, okay? Don't include listed property. So right here, we have assets that are 3-year property, 5-year, 7-year, all these good things. It's going to list all of these years. We're going to go in and we need to know the month and the year that it is placed in service, the basis for depreciation, the recovery period, the convention, the method, and then calculate the depreciation deduction, okay? Now, in addition to this Form 4562, you should be keeping what we call a depreciation schedule, which is going to literally list every single asset in your business. Okay, every asset that you have that is going to be depreciated, it is going to give you information about when it was placed in service, if Section 179 depreciation was taken, if so, what amount, if bonus depreciation was taken, if so, what amount, what is your starting basis, what is your remaining basis, what is this year's depreciation, okay? It is so imperative that you have a depreciation schedule. So imperative that you have a depreciation schedule because you're not going to necessarily list all of your assets on here every year. You're going to list the first year that they go on there. You're going to have it on here. And then for the following years, you're relying on that depreciation schedule. It is so imperative that you have it. Okay? Especially like if you are going to go from one accountant to another accountant, the majority of the time, the one thing that I'm missing when I have new clients come to me is depreciation schedules. Accountants like to keep it. They like to keep it and not give it, and you have to have it, okay? So I cannot stress enough. You have to keep a depreciation schedule, okay? Now I realized as we were looking at Form 4562 that I forgot to explain what listed property is, so I'm going to do one more thing before I end the video. Listed property here, this is back to publication 946. It is any of the following: passenger automobiles, business aircraft, any other property used for transportation, and then property generally used for entertainment, recreation, or amusement. So this is subject to some different regulations because these are assets that are generally abused by business owners that are really kind of personal items or for personal use or for mixed use, and they are listed in an attempt to completely depreciate them on the business return. So because of that, the IRS requires you to do some additional steps with your listed property. Notice on Form 4562, your listed property sits in Part 5, okay? So your listed property is going to sit in Part 5, and you need to list it out because the IRS wants some additional information about these listed items. Okay, these listed property assets, the IRS wants to know, okay, what are we doing with this? Is this really business use? Okay, so that is Form 4562. I hope that it was helpful. If you have any questions, please let me know. And if it was helpful, I would appreciate a like and subscribe. And I will cover Section 179 and bonus depreciation in the next videos.